One short topic from Leases IFRS 16. We discussed a lot about lessee accounting because lessee accounting is mostly tested for academic purposes. But sometimes lessee accounting they can also ask you, or even if they don't ask you an exam, in real life you might face the lessee accounting because you might be working in a company which is giving out equipment on rental or some other assets on rental. So let's see the lessee accounting. Lessee accounting means the accounting from that perspective when you are giving out equipment for lease. You are not taking equipment on lease, but you are giving out equipment on lease. So in lessee accounting, we use the same two terminologies, finance lease and operating lease. These are the terminologies we use in IAS 17 as well. So remember that in lessee accounting, under the new standard IFRS 16, you have the word lease and you have the word contract, which is also called service contract. These are the two words, two types of leases you have for lessee under IFRS 16. For lessor, you don't call it lease or contract, you call it finance lease and operating lease. And these are the same terminologies we used for in IAS 17, the previous standard. So in essence, operating lease is a simple rental agreement where you do not make someone the owner. You give some asset to someone, they use it, they pay you money, and you take it back. Just like you give out house on rent, you give out office on rent. When you give someone your house on rent, most of the times the case is that they will live there, they will give you rent, and they will not become the owner of the house. The house comes back to you. So that is an example of operating lease. The finance lease is a situation where the lessee will become the owner of the asset after the lease period. So finance lease is where a lease receivable is recognized in the statement of financial position. So you call it lease receivable. So what is actually a finance lease? You should consider finance lease as sale of an asset on credit. To be very simple, in finance lease, because you are telling someone that I'm leasing you this car, you will pay me installments for rentals for 5 years. After 5 years, you will become the owner of the car. So you have an intention of transferring the title from the very beginning. So finance lease should be seen as sale of an asset on credit, and therefore you record the receivable. You record the receivable because you are giving away the asset. Now, the principle on the finance lease was, and usually what you do, that first you see that lease, is it a finance lease or not? If it meets the finance lease criteria, you call it finance lease, all other things will become operating lease. So IFRS 16 identifies 5 examples of situations which would normally lead to a lease being classified as finance lease. And when I say finance lease, I mean that I'm talking with reference to lesser accounting. Number one, the lease transfership, the lease transfers ownership. You transfer the title of the asset. You give it to someone else's ownership. Number two, the lessee has option to purchase the underlying asset at a price expected to be sufficiently lower than the fair value. This is the same condition available in IAS 17. This is the same condition which was available in IAS 17 as well. Number three, the lease term is for the major part of the economic life of the underlying asset. Asset has a life of 10 years. Your lease contract is also 10 years or close to 10 years, maybe 9 years. So somebody else is not going to use it. So only this one lessee is going to use it. Again, the same condition in IAS 17. The present value of the lease payment, the present value of the future lease payments is equal to the value of the underlying asset. Again, the same condition of finance lease as per in IAS 17. And the underlying asset is of such specialized nature that only the lessee can use it without major modifications, which means nobody else can use it. So again, that is an example of finance lease. Literally, these are the same criteria given under IAS 17. But the thing is that before these criteria, we were applying from both sides, for lessee and for lessor. And we had the same thing, finance lease, operating lease for lessee and for lessor. But this time, these criteria and these two types of lease, finance and operating, they only apply to lessor accounting. For lessee accounting, we know how to do right of use asset and present value of lease liability. Lessee accounting, we already have done. We have done 4 lessons on that. Additionally, the following situations which could lead to lease being classified as a finance lease, because sometimes it's not necessary that all of these 5 criteria will be available, because when you will see the contract, maybe 1 or 2 or 3 would be justified, even 1 would be justified. So you need to see the available information. Additionally, the following situations which could not must, which could lead to be classified as a finance lease. 1, any losses on cancellation are borne by the lessee. If there are losses on cancellation, so it means that lessee will not like to cancel the lease. He will continue with that. That's a finance lease. Gains, losses on changes in residual value accrue to the lessee. If there are any changes in the gains and losses on the residual value of the asset, and if the lessee is taking those gains and losses, so it means that the lessee is taking the risks and rewards of ownership. We have a word which is called risk and reward of ownership. So to identify who is the owner of the asset, you always see that who is the owner of risks and rewards, who gets the benefit and who gets the punishment. So in this case, if there's any gains and losses in the residual value, and those losses and gains, they belong to the lessee, then it is a finance lease. Then we say that lessee is the owner. And last of all, the lessee can continue to lease for secondary term, which means that lessee has a right to extend it, not with mutual consent, with one-sided. Lessee, you give the right that he can extend the contract at a substantially lower than market rent. Substantially lower than the market rent. So which means that one contract will finish, and then he can sign another contract at a lower market rent. So it means that he is definitely going to continue, because it has been substantially lower than the market. He's not going to let it go. He will continue. So he's the only owner. He's the only one getting benefit from this asset. All of these conditions, you can actually add all of them in one number. I would say A, B, C, D, E, F, and G. Don't put them separately. E, F, and G. These are the 8 conditions. When you see these conditions, it is called a finance lease. If these conditions or these criteria are not met, then all other leases are operating lease. This was the understanding. Now, in finance lease, how do we do that? At the commencement date, which means the date the lessor makes the underlying asset available for use by the lessee, the lessor de-recognizes the underlying asset. The lessor will remove it from its balance sheet and recognize a receivable. It will be called a receivable. The name of the receivable will be net investment in the lease. So from your balance sheet, that non-current asset will go, and instead of non-current asset, you will introduce one line item. You will call it net investment in the lease. And this is your receivable. And this includes 2 items. Number 1, the present value of the lease payments receivable by the lessor. Present value, the same thing which lessee was recognizing as a liability, he is recognizing as a receivable. Like, you've got 6 million, 5 payments. So all of the 5 present value of these 5 payments, plus the present value of any unguaranteed residual value occurring to the lessor. Because when this asset will be returned back, now what will happen? You are the lessor. He is giving you 6 million, 6 million, 6 million, 6 million, and you will find out the present value. This 30 million present value is 24. Plus, you will also get the asset back, and this asset will have a residual value, and this is unguaranteed. Unguaranteed means that lessee is not going to make payment for that. You expected that I will be able to sell it this much in the market. There is no firm commitment, but there is an expectation. And you find out the present value of this also. This is your total. Why do I say unguaranteed? Because the guaranteed amount is within this amount. Guaranteed amount is within this amount. Just like when the lessee was making his right of use asset, he was saying present value of the future lease payment plus any guaranteed payments. So those guaranteed payments actually are included here. So there are two types of things. Guaranteed payment means that where lessee says that I will give you 6,666 plus I will give you at the end for this asset. If the asset is not sold for some money, I will give you $10,000 or $100,000. Imagine that I'm giving you my one heavy duty truck. I'm a lessor. You are a lessee, and you say that you will pay me 5 rentals for 40K, and I say that, you know what, 40K is too little. My truck is very expensive. When you will use this asset, it will be in a very bad shape and it will lose all its value. This is my 200K truck I'm giving you, and it will be zero at the end of the life. And you say, no, Mr. Ali, it will not be zero. I'm going to properly maintain it. I say, okay, fine. But what if I need my truck to be for $30,000? You say, yes, if it is not sold in the 30,000, I will give you 30,000. Or if it is sold less than 30,000, I will give you the difference of that. So that is a kind of a guaranteed amount. So guaranteed amount is promised by the lessee to the lessor, and guaranteed amount is included in this one. Because it is possible that I might be able to sell it in the market for 45,000. So I've got 30,000 as a guaranteed amount, and I have an expectation that 30,000 he has committed to give, but I'm going to sell it for 45. So 30 I will include inside here, and the present value of 15 I include in here, because I also expect this to come to me. I expect 45 to come to me, but out of 45, 30 is guaranteed, which is inside, and 15 is here, and both will be taken at the present value. So this is called guaranteed and unguaranteed amount. So this is actually, if you call it a name, it says net investment in the lease. The other name of this thing, you could consider it as receivable. That's all. This is the present value of your receivables. What do you expect from this asset? So I'm de-recognizing the asset from my balance sheet. Whatever this asset was, I will remove it. Instead of this, I will add my net investment in lease. And this amount will include the lease payments plus in unguaranteed amount. Okay, unguaranteed residual value is that portion of the residual value of the underlying asset, the realization of which by a lessor is not assured. Like I said 45, he said 30, 30 was assured, 45, 15 is unguaranteed.
Excuse me, sir.
Yes, please.
So when we de-recognize, when we de-recognize, what could be the entry? Because there will be a book value, right? So how do we?
For the book value, I will de-recognize, credit the non-current asset and debit this net investment.
Actual depreciation. Yeah. So hello.
Yeah, I understand.
Yeah. So there will be a net book value, right? So where will I close that balance? Net book value.
Net book value of the asset will be gone. I will remove the asset. I will say credit non-current asset. It had a net book value of 100,000. I will make credit to 100,000 and debit to net investment, net increase in investment. And that might be different than net book value.
But net investment in the leases will be a present value of that will be different calculation, right?
Yeah, it is a different calculation and it might be different. It is possible that my net book value of the asset was 100K, which I will recognize. The asset which I'm going to recognize is my net investment, and it is possible that my net investment is 120. Because if it is less than 100, I will not give. Why I'm giving it to someone? Because I have to recognize this thing. So there might be a difference in the two values.
Correct. Yeah.
And that of course will be part of the equity. Ultimately, we'll show this calculation as well.
Okay.
Then you've got finance income. Now what will happen? That because you are calculating the present values, like you know that you have 6 million and 6 million and 6 million and 6 million, which makes 30 million in total, but you recognized as a present value as 24 million, let's suppose. You are recognizing a PV. And you know that the unwinding of the finance cost, remember? For one party, unwinding becomes interest expense. For the lessor, you have got a finance income because you are earning interest on that. So every year when you will get some payment, it includes interest income. Just like the lessee is paying the interest recording finance cost, the lessor is recording the finance income. The finance income is recognized over the lease term based on the pattern reflected a constant periodic rate of return. So remember that I'm going to receive 30 million in cash over the period of 5 years, but I have recorded only 24 in my receivable. So whatever is the difference, that difference is actually my finance income, which is split over 5 years. Just like you have finance cost for one party, finance income for the other party. Let's do one question together, and then we will better understand the scenario. So it says that illustration number 5, a lessor enters into a 3-year leasing arrangement, lessor. So we are doing it from lessor's perspective. 3-year leasing arrangement commencing on 1st January 2003. Under the terms of the lease, the lessee commits to pay 80,000 per annum commencing on 31st December 2003. So it is like paid in arrears. End of the year, he will pay 80,000. It is a 3-year lease contract. A residual guarantee clause requires the lessee to pay 40,000 or 40,000 less the asset's residual value if lower at the end of the lease term if the lessor is unable to sell the asset for more than 40,000. So 40,000 is a guaranteed amount. If he could not sell it for 40,000, if he could sell it for only 35,000, then 5,000 will be paid by the lessee. The lessor expects to sell the asset based on current expectation for 50,000. So 40,000 is guaranteed, but we expect to sell it in market for 50. So it means 10,000 is unguaranteed amount. The interest rate implicit in the lease is 9.2%. The present value of the lease payments receivable the lessor discounted at this rate is 232,000. So this 80,000, 80,000, 80,000 payments plus this 40,000 payment, 4 payments, 80, 80, 80, and this 40. Together, present value is 232,000. Show the net investment in the lease from 1st January 2003 to 31st December 2005 and explain what happens to the residual value guarantee at 31st December 2005. So what will happen? I will make this calculation like this. You would say that you have a present value of lease payment 232, and that includes 40 also, the guaranteed value. So it includes 80 times 3 plus 40 and the present value. And then you have present value of unguaranteed amount. How much is unguaranteed? 10,000. Because 40 you included inside, but you expect to sell it for 50. So 10 is coming extra, that extra 10,000. But it will come after 3 years. So you discount it with the 3-year factor. 1 divided by 1.092 power 3. Power 3. It makes 7679. So my net investment in lease is 240,181. This is the beginning amount. Then you have interest income. This is your finance income. 9.2%, you increase it 22, then he will pay you lease payment 80, it becomes 182. Next year 182 plus 9.2% minus 80,000, it becomes 119. 119 plus 9.2 minus 80,000, this is what I expected, 50,000. This is what we expected, 50,000. Now, on 31st December, now this is important, the remaining 50,000 will be realized by selling the asset for 50,000 or above, or selling it for less than 50,000. If you sell it for less than 50,000, then claiming up to 40,000 from the lessee. If you sell it, say whatever amount, up to 40,000, you will claim it from the lessee because that you include inside. So under the residual value guarantee. That's all. This is impairment. We will discuss not now. It is IFRS 9. When we will discuss impairment, IFRS 9 at that time we'll talk about impairment. If you have any confusion until here, it is quite simple, not really very difficult. But still, any question, any confusion, you can ask me.
Sir, this question is very clear, but I have another situation. Can I ask you another question?
Gain in PNL.
Hello.
Yeah, I'm listening to you.
Okay, sir. Supposedly in the given situation, they have given for how many years? I mean, 4 years, right? Okay.
3 years.
3 years. Okay. After 3 years, they're canceling the contract. They're taking back the assets, and the lessor deciding to use the assets for their purpose.
Yeah.
They're not deciding to go again to leasing out this.
They can do it for them. The asset has a book value of 50,000.
So they should continue carrying this.
Yes, of course. They will bring in. And there was one question by you, and you did not ask it. But let's suppose that my net book value of the asset on this date when I made the contract, the asset had a value of 260,000.
Yeah.
Let's make it like this. Not 260,000. Asset had a value of 200,000. And you are actually making your net investment in leases is 240,000, 181. So it looks like that you are making a gain on disposal because you are selling the asset, right? So you should recognize the gain on disposal of 40,181. You should say debit non-current asset. I'm sorry, not debit my net investment in leases, which is 241. Credit my non-current asset, which is only 200, and credit my gain on disposal. Because for me, this asset is sold. It's only that the amount will come in 3 years' time. I have sold the asset. And I realized this gain, and this gain has been realized. And when the gain realizes, take it to P&L. That's a fantastic transaction. I just sold an asset, I made a gain of 41,000 on the asset. Now, actually, you will be receiving more money. You are not going to receive 241. If you consider, you are going to receive 80 plus 80 plus 80 plus 40. So you're going to receive 8 times 3, 24, 280,000 you are going to receive, right? 28. Here it is 232. The difference will go to finance income. In your bank account, the cash will come as 80, 80, 80, and 40. And the remaining is the finance income, which you are realizing here. This finance income.
So basically, we are recognizing the gain on disposal on the year of the decision of leasing asset.
On 1st of January, here I will record the gain. When I dispose the asset, I derecognize the asset. Asset is not with me. How much was asset? 200. How much they have promised to give me? They promised to give me 241, 240, the present value in today's term. So I'm clearly making the 40,000 gain on this transaction on January 1st. I will write it down.
Okay. And we are recognizing the finance income over the period of lease period.
Yeah.
So that will square out these differences, the whole differences, of course. Okay. Yeah.
This is about lesser accounting.